Check 1, 2.
Go! Curious about real estate?
Yes!
Then you've come to the right place. Get the knowledge you need, get over the fear, and get started. This is the Michael Quarles Real Estate Show with your host, Michael Quarles.
Hello and welcome. This is Michael Quarles, and today we're going to talk about seller financing and the terms you negotiate with the seller when buying with seller financing. But before we can get into the terms, we need to speak a little bit about how you ask a seller in the first place if they're actually going to be open to and accept a seller finance transaction. Now, some of you listening today on the podcast, seller financing is going to be your only option. You don't have the money to buy it outright with cash. You do not have a buyer set up. You don't have a hard money lender set up. You don't have an liquid asset available to you to perform on a cash transaction. So you have one of two choices. You can either buy properties subject to the existing loan or properties with seller financing. Now, seller financing can be behind a subject to purchase. So they could own, let's say the house is worth $100. You're buying it for $60. There could be a $50,000 Bank of America, Wells Fargo, Chase, something loan, and there's another $10,000 that you'll owe the seller. Well, that's the $10,000 we want to talk about today. How do you pay that to the seller if that isn't readily available to you in liquid? Now, a lot of times, it'd be easier if you paid cash, but you don't always. Even if you can pay cash, I think it's important for you to at least ask the question of the seller, if they're looking for or accepting seller financing. So one of the important questions I always ask the seller when I negotiate a purchase contract is I ask them what they're going to do with the money. And we ask that question because we want to know, are they going to put that money in Bank of America and let it sit there earning a 1% or 0.5% or a 1.5% note? Are they going to put it in a T-bill? What are they going to do with it? Do they need to use it for vacation, school funds, another house? What is it? A lot of times people will tell you, I'm just going to put it in the bank. Well, if they're going to put it in the bank, then I'm going to explain to them what a bank does. I'm going to say, in layman terms, this is how a bank makes money. I don't know if you knew this or not, but you're going to take your money, and let's call it the $10,000 that we're talking about, and you're going to put it with a bank, and they're going to give you a certain percent of interest return. I mean, 1% on $10,000 is not a lot of money at the end of the year. Would we all agree on that? Shake your head up and down, and you'll be surprised if you shake your head up and down that the seller that you're communicating with will actually start agreeing with you. If you sit there and you don't have any emotion and your hands are folded, the seller's not going to agree with you. If you shake your head from right to left, left to right, the seller is not going to agree. You're telling them to say no. If you shake your head up and down, you're telling the seller, yes, I agree, I understand. But then you're going to go into explanation. A bank takes your $10,000, they're going to give you 1%. Then what's crazy about it is they get to borrow 10 times or an amount times the amount of deposit to loan it out to the other people. And let's call that amount, they get to take your $10,000 and borrow, because they have your $10,000 in their bank, another $90,000. So they're going to have a total of $100,000. So your $10,000 to the bank represents $100,000 for them. Then there's what's crazy. Your $10,000 that represents $100,000, and they're going to loan it out at an interest rate greater than what they're paying you. So let's assume for a second they're giving you 1%. If you go down to the bank and you try to get a car loan, you're looking at 2.9%. If you try to get a home mortgage, you're looking at higher interest rates. No matter what they're going to do, they're going to charge whoever they loan your money to a higher rate times 10 kind of thing. So your 1% to the bank is considerable. Just doesn't seem fair to me. So how can you make more money than what you would be making by putting it in the bank? That's an answer. It's real simple. And I think you already know the answer because you are already doing it. You know that your money invested in this property is a better place for that money as an investment than at Bank of America or any other bank, don't you? And shake your head up and down like you're asking them to say yes. They will absolutely say yes. When they say, yeah, that does make sense, repeat. So that does make sense. Terrific. So we always want to repeat what the seller says to us with a positive or a negative reinforcement word. If they say, that doesn't make sense, then you would say, that doesn't make sense? Really? And explain the situation again in better terms. I always start by saying, I'm sorry, I didn't explain myself well. And then I just go back into the same explanation. I don't change what I said. I just let them know by saying, I'm sorry, I didn't explain myself well, that it's okay for them to listen a second time. If I said, oh, you must be flipping stupid for not understanding what I said, they're not going to listen to me anymore. They're going to ask me to leave and they're going to sell their house to somebody else. I don't want that to happen. So I'm going to explain myself the second time. I'm going to shake my head up and down, and I'm going to get them to agree. Finally, I'm going to ask them again, so how much of that money did you need to move with? Or are you planning on financing any of that amount for the buyer? So I'm going to ask them again, how much of that money do you need to move with? Or are you planning on financing any of that amount for the buyer? And when I say the buyer, I am taking my left hand, because I'm right-handed, I'm taking my left hand and I'm pointing at myself. Like, I'm the buyer. Like if they were going to, if someone said, who's the buyer? Well, people would point to me. If someone said, who's the seller? They would point to that person that's selling me the house. But then the reason I want to say and point to myself that I am the buyer is because I want them, I'm going to embed again into their mind that I am the buyer. I'm absolutely there for only one thing, and that is to buy the house. I'm not there to see what color paint they used. I'm not there to see the backyard. I'm not going to how ugly the interior is. I am there to buy the house. So again, how much of that money do you need to move with? Or are you, yes they are, I'm shaking my head up and down, are you planning on financing any of that amount for the buyer? And I'm pointing to myself, shaking my head up and down. So they're eventually going to get it in their head that I want them to finance that portion for me, the buyer. And that's okay. And then I follow that up by saying, let me tell you how I buy houses and the terms within which I'll buy your house. Let me tell you how I buy houses and the terms within which I will buy your house. So let's go over the terms. It's real simple. I let the seller know any option is okay with me. Because quite frankly, all I care about is the price. I would like to have terms. Some of us are going to need to have terms. So if you can't buy with cash, you're going to eliminate one of the options. However, I can buy with cash. So if they say, no, Mike, I want to only sell with cash when I'm done presenting my terms, that's fine. In a minute, you'll understand why that's fine. I'm going to follow up that statement of I offer sellers different ways of buying their house, and any one of those is okay with me. First, I can offer you all cash. I'm going to come right out of the gate and say, although I don't want to buy it with cash, I want to buy it with terms. But I'm going to come right out of the gate and say that one of the ways that I offer the seller to buy their house is with cash. It's your most expensive way of selling me the house. I want them to know that. I'm not going to explain it yet. I just want them to know it. At times when the current loans and liens against the home qualify, I buy subject to the existing loans and liens. So why wouldn't a loan or a lien qualify? Well, very few cases, but let's assume for a second we have an involuntary mechanics lien against a house and we didn't pay for the fence to be, built in the backyard. They slap the mechanics lien. They have to cure the mechanics lien by taking that lien to court to force a sale, foreclosure on the property. I don't want to buy a house that way if that lien is too high. Most liens wouldn't be, but let's assume for a second that they did built this functional obsolescence thing in the backyard. They put a tree house back there that cost $40,000. Tree house is not going to do me any good. It's not worth $40,000, but they spent $40,000 on it, never paid for it, got a $40,000 involuntary lien, I'm not buying the house. I'm walking away. Can't take it, not going to do it. Unless that's the only lien and it's a $100,000 house and all they do is say, I just need to take care of this $40,000 lien. Absolutely, I'm going to buy the house at that point. So I'll just give the lien holder $40,000 or less. Because I know that a lien holder that's curing a mechanics lien will accept less because there's costs to cure it. And I'm an impartial third person now. I mean, they're not mad at me because I didn't pay them $40,000 for the tree house. They're mad at the seller, but because I'm not the seller, I'm communicating with them. I'm starting to negotiate with them. They'll take less than the 40 for me, where they won't take less than the 40 for the seller. So in a case like that, and a case where I'm fine with going ahead and saying, okay, I'm buying it low enough. Worst case scenario, I'm going to cure it. I'm going to take my cash and cure that mechanics lien, pay it off. Or the best case scenarios is I'm going to negotiate with that lien holder, that mechanics lien holder, and say, my intention is flipping this house, and within 90 days I'll have that taken. If you can go ahead and do a stipulated judgment and turn that involuntary mechanics lien into a voluntary stipulated judgment, which is the seller who entered into that in the first place agreeing, which once I become the buyer, I now am assuming that lien, that at 90 days we're going to pay that lien off. So and then the third one is right after I say, when the current loans and liens against the property qualify, I buy the subject to the existing liens and loans. Rarely do I buy utilizing an option. So we have two types of options, two famous types. We have lease option, which I'm not going to get ownership with. Basically, I'm going to say I have the right to inhabit it or put someone in it, inhabiting it, and I have the option to purchase it in the future. That's a lease option. And there's various terms and negotiation techniques that we can use to make that lease option viable so we can turn it into a sandwich lease and find a buyer tenant who wants to go into that property under a lease option and make money certain ways. We're not going to talk about those today, but we will talk about them in other podcasts. But the other option is just a blanket option to purchase. So I'm not going to say I'm purchasing your home today. I'm going to enter into an option to purchase it at my will in the future. You can go ahead and sell it to somebody else. However, because I have the option, you have to give me the first right of refusal. If I refuse that, if I refuse to enter into my option and cure my option, then you can sell it to somebody else. But if I always have the choice for a limited amount of time, whatever time we put on the option agreement. And at times, a combination of cash, terms, and subject to. So we talked about cash. We talked about taking the house subject to the existing loans and liens. We talked about the option. We talked about the combination of cash, terms, and subject to. And at times, the seller chooses that seller financing is in their best option. A lot of times the seller, and I'm saying this to the seller, so I'm not saying it to you, I'm saying it to the seller. A lot of times the seller, and I'm going to shake my head up and down, you're the seller. I'm doing the Bill Clinton, kind of point with my knuckles, not my finger. I want them to know I'm talking to them. I'm directing it to them. This is something for them to listen to. A lot of times the seller chooses to seller financing. I'm shaking my head up and down because I want them to choose it. This is their best option. So when we say that, if we go, a lot of times they seller financing, this is their best option. Let me restate that. We've got to be slow enough when we say this is their best option. And now we can take that word there and let's put your. This is your best option. Make sure they understand it. I'm pointing with my Bill Clinton knuckles. I'm agreeing with them. I'm shaking my head up and down. I don't have my hands folded, and I'm not shaking my head side to side. So I'm going to take my left hand. I'm now going to point at myself, pat myself on the chest. I want them to know it's me. I can offer you the best, shaking my head up and down, price, and fastest close. Last question. It's an important one. When you ask it, be quiet after you ask it. So it's a simple, real easy. It's 6 words. Gotta ask it. Which option is the best for you? And be quiet. Let them think about it. It's been so long ago since I asked them if they wanted cash, they don't even remember cash. I skipped over the middle part, although I explained some of that stuff, but I really emphasized the last option, the last one that they heard. So let's face it, the thing you hear last, you'll remember the most. They just heard the best option for you is seller financing. You've already asked them what they're going to do with the money. You already know they're putting it in the bank. Can you go from, I'm not putting it into the bank, I need to buy a house with it, into offering them, requesting seller financing? Absolutely. As long as the need for the liquid asset, the cash that they're going to get, isn't needed within 6 months. If they say, no, what we're doing is we have a house we're going to close on next week, that's why we need to sell it and get the $10,000 to close that house, can't offer them seller financing, doesn't make sense. I can still offer them subject to financing with a cash purchase for the balance. That is a good option. Or if that's not an option because they qualified for the new loan based upon this loan that they have now being paid off. Now I know how to orchestrate that, but in a week, a little hard. So in that case, then I know my only option is all cash, which is fine as long as I'm paying less than 60 cents of the as-is value cash. So if I'm negotiating a contract and the lowest the seller will agree to a price is 75 cents on the dollar, I can't pay cash for it. I could pay seller finance terms for that. I could take that subject to the existing loans and a seller finance term on that, but I can't pay cash. And the reason for that is my safety net. Your safety net should always be, I can go to a hard money lender, someone that you should have set up in advance, and I can orchestrate not a line of credit, but establish a working relationship and understand their criteria. There's 2 types. There's hard money lenders that do equity loans, so they only care about the equity in the property. So they don't even ask you they want your name because you have to sign something, but they don't ask you for your social security number or anything like that. That's the hard money lender you want. The other type of hard money lender, you're still doing a little bit of qualification based upon your performance in the past. But I warn you, for hard money people, don't go that direction, because if they're pulling your perfect credit report, your credit report starts getting dinged. Well, you don't want to hurt your credit while you're buying all these houses, because this is not the only opportunity you're going to have. And you don't want your credit report to be pulled every 3 weeks or every month or every 2 weeks, because your FICO score is just going to go down and down and down. So find the hard money, the equity lender that only cares about the equity in the property. Find out what their criteria is for determining the equity base. Now, it's not as easy as that sounds, because most hard money lenders, because they're using their own money, their own resource, when they say, I loan 65% of as-is value, their as-is value may be less than your as-is value determination. So it's important for you to understand, how are they determining that? They may say, it's real easy. I'm going to take the lowest valued cell for like-type property within a quarter mile, and that is the highest value. So the lowest cell is the highest value that I'm going to put on the property, subtracting any differences in the like-type properties. So if you knew that and you said, okay, well, my hard money lender and I both see the property values the same way, and they'll give me 65 cents on the dollar, as long as I tell the seller I'll give them less than 60 cents on the dollar, there's a magical thing that's going to happen. You will absolutely be able to borrow more money than it costs you to buy, because the equity lenders don't care. It's not a bad idea. Let's assume for a second you find a property that you can buy at 50 cents on the dollar, and you can get a 65% hard money equity loan to value. That's 15% you can put in your pocket. Let's say, for instance, you need that money to do marketing, you need that money to do in business, you need to fix it up, you have to paint it a little bit, or whatever you're going to do to turn around and flip it. That's a nice day. Typically, your hard money lender is going to want to see some performance before they start cashing you out. So don't expect it on the first one, but absolutely expect it on the third, fourth, fifth, and those subsequent ones after that. You'll absolutely be able to borrow some money outside of and above your purchase price. So now we have the seller saying, yes, I'll go ahead and do seller financing. That seems reasonable. I want to make more money than the 1% I'm going to give Bank of America. I don't need the money. It was just an investment. Yeah, it sounds to earn more. Besides that, they get paid more. So what do you offer a seller if they're going to do it? Seller financing. That's a great question. So now the sellers agreed, yes, it's in my benefit to accept seller financing terms. So now you have to agree on the terms. There are 5 components that make up the terms of a note. Main components. We're not talking today about exchangeable collateral. We're not talking about early payoff reduction. We're not talking about due on sale or lack of. We're not talking about any of those kinds of things. What we're talking about, the 5 main components of a seller financed note or agreement is 1, the price. What should you pay? How much should you agree to pay a seller for their property, knowing that the seller is financing the complete balance of the purchase price? So this isn't subject to plus seller financing. This is 100% seller financing. So that means that when you close escrow using a closing company, closing attorney, title and escrow, that all voluntary and involuntary liens or mortgages and loans against the property will be paid off by the seller, and then they are going to record a deed of trust as security for their loan, their note that they're signing with you. So how much do you pay? And I believe that you should not pay more than 70 cents on the dollar. So if it's worth 100, they're only going to receive at some time in the future $70,000 as principal balance on a note or a loan. If it's cash, I'm only going to offer the seller 60 cents or less. If it's seller financed at 100%, I'm only going to offer the seller 70% or lower. I will never go above 70, and you may ask me why. The answer into that is because we do enough marketing, we have enough opportunity that if I don't deviate from my preset in stone, in granite, I will only buy 70 cents or less, and this seller wants 75. If I don't deviate, and I say, no, I'm not going to agree to 75, I'll just go buy another house because I have enough marketing going on. I have enough opportunity. It's when we don't have enough opportunity that 70 cents on the dollar gets inflated to 73 cents or 78 cents or 81 cents. As long as we're creating opportunity, we can make opportunity choices based upon what's in the benefit for us and what's a benefit for the seller. It should always be a win-win. And the seller is winning when they offer me seller financing because, one, they're going to have their property sold. That is the key component when we buy houses, is that a seller wants to sell a piece of property. The other component in this is that they're going to at least make or could make 10% more by offering me seller financing. Now, if you have the cash sitting in Bank of America, and let's assume that it's a $100,000 deal and a cash term, you would have to give them 60, and you have $60,000 in the bank. Or they'll go, wait a second, or you can give me cash, that's fine, I'll agree to 60 on cash, or I'll finance it for you at 70. Which one's best for you? Some of you listening will say, well, if I have 60, 60 is better because I'll make an extra 10,000 spread. That makes a lot of sense. Absolutely. But what happens if the phone rings tomorrow and that seller doesn't have the ability or a desire to give you seller financing, they only want to sell for 60 cash, same type property, same purchase price, and you only had $60,000 to start with. Well, if you bought the first property for cash, even though you could buy it for terms, and you found another piece of property that did not qualify for terms, it was only a cash, well, you can't buy it for cash. So now, without going down and getting a hard money loan, without having that exorbitant amount of interest and exorbitant points. So if you are in a seller finance transaction opportunity, you probably should take it. You should probably always take it. And one of the key components to that is besides it being more economical for you because you can now buy more homes or housing with your liquid asset, you're also establishing a relationship with a seller who has $60,000 or $70,000. I mean, you're going to pay them off eventually. You're going to give them $70,000. And starting a relationship with someone that doesn't need $70,000, that's a pretty good relationship to have. Because there's going to be a time in the future where you have less resource than opportunity. But you remember the guy or the gal that 3 months ago financed a property that you bought. You fixed it up, you flipped it, you wholesaled it, you held on to it, had refinanced it, put a conventional loan on it. You paid that seller off. And you had a great working relationship with that seller. You know they have $70,000. Now you're buying another piece of property. You need 40 grand. Who do you call? Well, you call the seller that you had a great relationship with, that you proved to that you are a professional because you made the payment or payments or whatever the terms were on time. You followed through and you did what you needed to do. You couldn't do that if you didn't accept seller financing originally. So if I know that you're going to give me seller financing, I don't choose that as an option. I go ahead and just take cash out of my bank. I pay you cash. I make $10,000 more. 3 or 4 months later, I need $40,000 that I don't have. Do you really think I can call you back up and say, hey, remember me? I bought your house and I went with cash instead of seller financing, and you said that you could seller finance it for me. Do you want to do that now on another deal? They're probably not going to say yes. They probably won't even remember you, really. Oh, yeah, you're the guy that bought the house from me 4 months ago. However, if you created a relationship with these people on purpose, they will remember you. So the price is the first one. It's an important one. That's why it's the first one. The down payment is the second one. So now I'm buying that $100,000 piece of property. I'm going to buy it for $70,000. But how much of the $70,000 do you want? Well, it's a crazy question, but you kind of have to ask it. Because the reality of it is, if I ask you the right way, we're not talking about this question. So I said, so great, you're going to be putting that money in Bank of America. Fantastic. Let me show you how you can make more money with that. Since you were going to put the entire $70,000 at Bank of America, then we can assume that there's going to be zero down payment. Makes sense. But you don't want to skip over things because you think they should just be skipped over. Because if I say it that way and the seller says, well, I'd like to see a little bit of money, that means it's important to them. So if someone says, well, I'd like to see a little bit of money, the question always has to be, you say you'd like to see a little bit of money? Wow, really? Ouch. How little bit were you thinking? And when you make that statement, if you say it in a tonality that is an objection, because if I said, oh, really? Well, how much were you thinking? Like it's exciting, my pitch of my voice is higher, my speech pattern's faster, they're going to just pick. They're going to pick the world. I just, hey, I was thinking maybe $65,000 down. I'll finance $5,000 for it. Folks, that's not seller financing. So how much of that of a down payment were you thinking? Give them some doubt. I don't care what number they send back to you. If it's over 5%, don't take the deal. Or you have to reduce the value. So if someone came to me and said, Mike, I'm going to seller finance your transaction for you. I agree. That's a better place for me to put my money. And I've told them that I can give them $70,000 for 100% seller financing. But I've also asked them if they needed me to put any money down, and they said, well, I want to put down 5,000. Then I have to ask them, well, or make a statement rather than ask them, well, that changes the amount that I can pay you. So let's do this. If you want me to put down 5,000, then I can buy your property and I can finance $60,000 for a total purchase price of 65. You back off 5,000 or equal dollar to the amount that they want in down payment, they're going to go back to 100% seller financing if you've done your job right. But if they say, oh yeah, that makes sense. Yeah, I'll do 60, put down 5, I'll do 60 carryback. Come on, people. $5,000 really? If we can't come up with $5,000 from family, friends, credit cards, second job, not going to eat every night out to dinner kind of thing, stop the movies for a couple weeks, whatever it is, we don't need to be in the business. So I mean, everybody, if they needed to, they can touch $5,000. I absolutely know you can. Just have to ask the right people if you don't have it. And there's nothing embarrassing about asking mom and dad, brother and sister, coworkers, bosses, friends, beer buddies, whatever it is. You just say, hey, I have this opportunity to buy a house. I need $5,000 more. Can you see yourself doing that? Great. Negotiate some terms, get it in writing, making a business proposition, not a handshake. Nothing worse than not doing that. So the seller and I agreed that they want me to put $5,000 down. I know I can do that. We've also agreed that because they want the $5,000, that the purchase price went from 70% to 65%. The next question I have to ask them is the interest rate. Now, earlier, if I told the story that they were going to make 1% put in the Bank of America, it's probably real hard for me to negotiate 0% interest on the loan. But it's not always hard to negotiate 0% interest on a loan. Because if the seller comes to you, and let's call them an absentee seller for a second, they have a piece of property, it's worth $100,000, you can now buy it at $65,000 with a $5,000 down. But for the last 10 years, what they've been accepting is $450 a month in rent. And out of that $450 a month, they've been having to pay insurance and taxes and all those things. The repair costs, the vacancy costs, what have you. But let's just use the $450 that they've been making or earning every month as the example here. Because I can ask the seller, so if we orchestrated the $65,000 note where I pay you $450 a month, which is what you've been receiving, yes, shake your head up and down, and I pay you the $450 until the $450 pays off the principal balance, that'll be fine. Shake your head up and down. Because believe it or not, there's some people that will say, yes, that's all I want. So you take the principal balance, divide it by $450, and that's how many payments you have to make. In a situation where that wasn't the case, and you have to talk about interest rate, naturally 0 is always better. For usury, there are maximums. But in most states, when a seller finances a transaction, usury amounts don't apply. So sky's the limit kind of thing. Definitely don't go over 10%. 10% would be crazy. But what's reasonable? If I came to you and I say, well, can I give you twice as much money today than what you were earning yesterday? Say for instance, you were an employee and you were making $15 an hour somewhere. If I came to you and I said, can I give you $30 an hour? Would you say yes? Maybe, maybe not. Okay. If I came to you and I said, can I give you 2.5 times? Can I give you $37.50 an hour? You probably get more excited. What if I came to you and I say, can I give you 3 times the amount of money that you would have been making at Bank of America? So you came to work for me tomorrow doing the same job you were doing yesterday, but now today instead of $15 an hour, you're making $45 an hour. And here's the kicker. You get to decide how long you want me to pay you $45 an hour. Interest works the same way. They were going to make 1% at Bank of America. Maybe 2% is all they want. Maybe the $30 an hour is fine for them. Maybe the $37.50 to 2.5%. Maybe the 3% or the 3 times is fine. 3% is really good for me because I know I can't go out to a hard money lender and borrow it at 3%. I'm going to be at probably 12, 14% and 4 to 10 points. Well, it's going to cost me a considerable amount of money to borrow it from a hard money lender. So if I can get you to accept, as a seller, accept 3%, absolutely I'm going to fall forward. And so would you, because it's reasonable. Here's the kicker. What's the length of the loan? So now I bought this house, $100,000 value. We originally negotiated 100% seller financing 70. They decided they wanted $5,000 down, so we had to lower the value to $65,000. They agreed to 3% interest, which is pretty good. But how long before I have to pay that off? Well, in the big picture of things, that really depends upon your business model. If you're going to be a buy and hold passive income earner, you're going to say, well, I'm going to rent it out for the next 15 years. Can I do 15 years? Really? Yeah. Well, that seems reasonable. I mean, there's only, 3 mortgages out there today, typically 30 years, 15 years, and 10 years. And you can take a note. Say you go, well, the seller says, well, I'd like to have the money in 10 years. Great. Fantastic. As long as it's more than 5, you're fine. This is not a sticking point, as long as it's more than 5. And it can be less than 5 if you want. We just have to cause things to happen. Less than 5, well, that means can't do what I wanted to do. So now we have to work on that $65,000 purchase price or $60,000 note. I may reduce it a little bit for short-term money. Maybe I won't. It depends on what I think I need to flip, because I'm a wholesaler. I'm a massive income earner. I'm not going to go out there and fix toilets. I understand why people do. I'm just not that person. So I would go ahead and take the deal at a shorter term loan, as long as the shortest term loan must be 12 months. It must be, let me say it again, the shortest term on the seller finance deal must be 12 months. It must be. Now, I'm in California. In California, if it's a short-term loan, the seller doesn't have to notice us. Like things like your payments, payoffs coming due. But if it's a long-term loan, there's certain months that have to pass. And then prior to the payment becoming due, they have to give us a notice that says, oh, in case you forgot, you have to give me the amount of money on this date forward. I'm not going to forget, and I'm not going to use that as ammunition for the seller. Just know that there are things and rules out there like this. So let's say, for instance, the seller says, I want to do a 24-month loan at 3% interest. I'm fine with that because I know I'm going to rehab it and flip it, or I know I'm going to sell it as is, as a hotel, and flip it. It's because I really don't need a length of time that I need the money, because I know that, a week, a month, 3 months, 4 months, that the seller's going to be paid off anyway. But my key component is the last question I have to ask. How many payments do you want? Now, earlier, one of the scenarios was, well, I'm getting $450 a month from my tenant, and I don't mind 0%. We can just take $450 divided into the $60,000 loan, and when you're done paying me the $450, I'm fine. So that's a 0% interest loan, and they want monthly payments. And you figure out the length of the loan by $450 divided into 60, whatever that number is. But in this situation, I need to know, because I'm borrowing $60,000 at 3% interest over a 24-month period. I need to know how many payments do they want. Do they want one? They want one at the end of the 24 months. Wouldn't be a bad thing. It'd be easier accounting. Do they want it evenly dispersed over a 24-month period? So I have to take $60,000 and figure the interest rate at 3% and do the whole amortization schedule based upon 24 months. That would be expensive to me, because let's face it, if you are having to tear down a loan over a 24-month period, amortized for 24 months, 24 into 60, that's what, $2,000, between $2,000 and $3,000. So that probably wouldn't be my benefit unless I knew I was going to sell it within a month. But keep in mind that holding cost adds to the value of that note. So if you have short-term money, 24 months is short-term. Anything less than 5 years is short-term money. If you have short-term money, you really want to stick to one payment. When I pay you off at the end of 60 months, we're going to make one payment based upon 3% interest and negotiate that. Keep it in mind that everything that you negotiate, all the costs that you negotiate that are costs against your value, that you have to mitigate those costs by a reduced purchase price. So if someone comes to me and they say, no, I want evenly amortized payments over 24 months, so I want you to give me between $2,000 and $3,000 a month, I've really got to think hard. Do I want to do that? Now, if I already know I have it sold because I have a great buyers list or some of the past offers that I've received from sellers, real estate agents, I know that I can pop this house off and I don't have a problem with it. At that point, I don't really care, because what's $2,000 kind of thing. At the end of the day, because I know I'm going to make $30,000 after I pay my costs to the real estate and closing companies and all that kind of stuff. So But let's go back to the example. Let's say they want payments during the first 24 months because the note's due in 24 months. They want monthly payments. The question we have to ask the seller at that point is, let's make a statement. So you want to be paid, you want a 24 months payment, everything due and payable at the end of 24 months. So amortizing that over 15 years is fine. Or amortizing that over 30 years is fine. Because most mortgages are amortized over 30 years. 30 years of equal payments, pay that thing off. And a lot of short-term notes are amortized over 15 or 30 years. So if you go and borrow, a 5-year note that's all due and payable, well, it's not amortizing over 5 years. It's going to amortize over 30 years or 15 years. Seems practical to me. What that allows you to do is that allows you to have, less payments while you're holding the property, while the seller is still earning ultimately the same amount of money. Actually, they're going to earn a little bit more because they're going to have interest compounding on interest, which is a good thing for them. At the end of the day, not a big thing for you. And once you agree to all this, then you're going to keep this in writing. Everybody's going to agree with it. It's going to be part of your real estate purchase contract. You're going to take it down. You're going to take that purchase contract down to your escrow company or your closing company or closing attorney. They're going to do a promissory note, and they're going to file and record the deed of trust deeds for you folks that is securing that promissory note, and everybody's good to go, and you just have to perform. And then perform so you can do it again with this seller/lender. And understand this is how easy it is. These are the things you go over. You're going to receive everything that you ask to receive. It's also important that you go over even the terms that you don't want. You have to bring everything up, because if you don't bring everything up, even though it's not part of what's going to be accepted and offered by you and the seller, you don't want the seller to ever think you're hiding something from them, or you're concealing something, or that you didn't mention something. It's so much easier to build positive relationships so you can continue that relationship far beyond paying them back. Because good things are going to happen from a positive relationship. You're going to have referrals. You're going to have repeat opportunity, either in purchasing another property from them or in financing from them. You're going to feel good about yourself and that you're credible. No one's going to be able to say bad things about you. It's going to be positive all the way around. And when you go out to buy a piece of property, understand what terms are important and acceptable to you. Use some neurolinguistics. Shake your head up and down, side to side. Point, tap yourself in the chest. Don't have your arms folded. Don't talk fast. Don't talk slow until you need to. Buy some houses. Fix them up, flip them, hotel them, keep them, rent them out. Doesn't matter. Seller financing will set you free. You'll be able to buy so many more houses with seller financing than you could ever buy with borrowed money from an institutional lender. So always think seller financing first. Great talking to you guys. Have a great day.
Thanks for listening to the Michael Quarles Real Estate Show. Get more info and stay in touch at michaelquarles.com.